Welcome to the White Coat Investor Podcast. This is episode 95. The Speakpipe is working. You worked hard to get your degree, and you continue to work hard to pay off your student loan debt. Consider a refinance with First Republic Bank and start working on what matters most to you. First Republic can offer you fixed rates on your student loans that are among the lowest in the country and could potentially save you thousands. First Republic is committed to helping you get out of student loan debt faster, so you can enjoy the benefits of your hard work sooner. Visit www.firstrepublic.com/whitecoatinvestor to learn more about First Republic's low rates and extraordinary service. That's www.firstrepublic.com/whitecoatinvestor. First Republic Bank, member FDIC and equal housing lender. Our quote of the day today comes from Warren Buffett, who said, "If a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle." I agree with that. He really has done a lot. Unfortunately, passed away in January, and we're really going to miss him. He's done a lot for the American investor, for sure. And you are doing a lot for your patients, so thank you for what you are doing. I don't know if any of them told you thanks today, but if they didn't, at least you've heard it from one person. Make sure you've checked out our recommended pages on the White Coat Investor website. I have taken a great deal of time and effort to come up with these recommendations for you for various financial services professionals. In fact, that's actually one of our three missions of the White Coat Investor. Our first mission is to help you get a fair shake on Wall Street. Our second mission is to feed my entrepreneurial spirit. That means creating jobs, building something bigger than existed before, but also involves making money. This is a for-profit business. But the third mission is to connect you with the good guys in the industry. And the main way I do that is through the recommendations pages on the website. There you can find student loan refinancing companies, doctor mortgage lenders, independent insurance agents, financial advisors, contract review companies, tax strategists, and other financial professionals. These are people that we've done some initial vetting on and that have had continual vetting from white coat investors just like you who have used them. Basically, people send me feedback, and if the feedback's positive, then we keep them on the list. If the feedback's negative, we take them off the list. And so be sure to use those when you're searching for a reliable professional, and of course, send us feedback about your experience. Today, we are going to do almost entirely questions from Speakpipe. They've been rolling in like crazy lately, and it's a lot of fun to get your voices on the podcast. So that's almost completely what we're going to do today. Let's take our first question from Keith. This is one member of a two-resident couple.
Quick question about my Roth for 2019. My wife and I both contributed a lump sum of $5,500 each to our Roths last year. We did so with money that we received from our wedding. This year is a bit trickier. We're married filing separately because I have greater than $350,000 in loans and she has none. We make the same salary and I'm going for public service loan forgiveness. As you mentioned in a prior podcast, I think it makes sense after running the numbers to file separately. But back to the Roth, since I am filing separately, I don't qualify for direct Roth contributions. So what do you recommend me to do this year since we don't have a lump sum ready to contribute? Should we A, save up $12,000 over the year and do a backdoor like near the end of the year, or B, contribute to our individual IRAs monthly and do backdoor contributions once per month? I'm only asking because option B allows me better coverage of the market trend and smoother contribution rate in that I get an average of the yearly market by contributing monthly and not just have my contribution be made at one point in time. Am I overthinking it? Thanks a lot.
Basically, the question is what to do about that Roth IRA. In case you have no idea what he's talking about, how much you can contribute to a Roth IRA if you are filing separately is limited by your living arrangement and your income. But typically, it's severely limited. If you live with your spouse at any point during the year and you make more than $10,000 per year, you cannot contribute directly to a Roth IRA. If you don't live together at all that year, the income limit is much higher. But basically, if you're doing the married filing separate thing in order to minimize your income-driven payments during residency in order to maximize your public service loan forgiveness, then you are not going to be able to contribute directly to a Roth IRA. You're going to have to do it through the back door, just like you will once you're an attending. It's not that hard to do. It's no big deal. You can do it. Lots of attendings are doing it all the time, but that's the way you have to contribute to your backdoor Roth IRA. A typical attending has enough money to make their entire Roth IRA contribution in one fell swoop. I mean, if you're making enough money that you have to do it through the back door, you should be making enough that you can do it all at once. It's only $6,000 for you and $6,000 for your spouse. Even if you got to do your spouse's next month, you can do it for you this month, etc. But the issue here is with a resident, they don't have that much income. And it's really hard to come up with $6,000 all at once as a resident. So it's much easier to come up with $300 or $400 a month to put in there and gradually max it out over the course of the year. When I was a resident, that was how we made our Roth IRA contributions. Now, we were married filing joint, so we could just make them directly. It was no big deal. But in this case, this couple is married filing separately. So they can't do that. They have to do the back door. And so what I would do, I would probably contribute to a traditional IRA as the year went along. But rather than doing the conversion every month after making a contribution, I would probably go ahead and just do the conversion once during the year. Now that probably means you're going to have some gains on that traditional IRA. And that is not the end of the world. I mean, you want to have some gains. That's the purpose of investing as you go along. But you are going to have to pay taxes when you do the conversion. For example, if you get $6,000 in there over the year, and by the time you do the Roth conversion at the end of the year, it's $6,300, you're going to owe taxes on that $300 when you do the Roth conversion. You have two other alternatives if you don't want to do that. The first one is every time you make a contribution, just do a Roth conversion. That's not a big deal. I mean, you basically just add it all up at the end of the year when you report it. It'll probably be reported just like you had done it all at once. But there'll be a buck or two, a few dollars you made on interest in between the contribution and conversion steps. The problem is you're going to have to log in and do that conversion every month that you make a contribution. That's not a big deal to you. I guess you can do that. The other alternative is just save up the money in a money market fund on the side or a high yield savings account and make the contribution at the end of the year and then do the conversion the next day. And that would keep things very simple, but you would miss out on any earnings that money could have had during the year. I guess you don't miss out on all earnings. You would earn whatever you're getting in the money market fund, but you would miss out on what stocks were earning or bonds were earning if you would have invested the money there. A couple other observations on this situation. First of all, in case it's not clear, you can't actually put wedding money into retirement accounts. The only money that can go into retirement accounts is earned income. Now, you can spend wedding money on your living expenses rather than spending the money you're earning in your job. But the bottom line is you cannot contribute more to a retirement account than your earned income in that year. Also, bear in mind if your goal is really to minimize your income-driven repayment payments, in order to maximize how much you get forgiven through public service loan forgiveness, you might want to consider making tax-deferred contributions to any account that you can, whether that be IRAs or 401ks. And the reason why is any money that goes in there basically comes out as a tax deduction and lowers your income. The lower your income, the lower your IDR payments, and the more that is left over after 10 years to be forgiven through public service loan forgiveness. Now that contrasts a little bit with my usual advice for residents. I generally tell residents that they want to invest in Roth accounts, Roth IRAs, Roth 401ks, Roth 403bs, because you'll never be in such a low tax bracket the rest of your life. But it's possible in some situations, especially when you're sure you're going for public service loan forgiveness, that you'd be better off using a tax-deferred account in order to lower those IDR payments and increase how much goes toward public service loan forgiveness. You just have to run the numbers for you and decide whether that's worth it. Okay, let's take our next question. This one's from Mark.
Hi, Jim. My name's Mark, and I'm an anesthesiologist in the Pacific Northwest. I had a question for you about taking out a loan against your 401k. I'm wondering if you could speak briefly about the advantages and disadvantages, and specifically, I'm curious your thoughts on this idea of the money that you use to pay back the loan being double taxed. There seems to be some differing opinions on the various forums online. Thanks so much. Appreciate what you do.
Okay, Mark's asking about loans against 401ks. First of all, let's talk about 401k loans. 401k loans are not a great idea, and the reason why is I want that money in the 401k making money. I mean, this is money that you're supposed to have put in there because you want to retire on it. This is not an ATM that you want to raid in order to buy your next Tesla or in order to go on a vacation or really even to cover emergencies. Hopefully you've got a separate emergency fund for that. But if you want to borrow from your 401k, you are allowed to do that. The maximum is either 50% of the value of the 401k or $50,000, whichever is less. That's the most you can borrow. And you have to pay an interest rate to the 401k for that loan. The longest the loan can be is 5 years. This used to be a really terrible idea because if you got fired, you had to have that loan paid back within 60 days of separation from the company. And when you get fired, that's a time in your life when you probably don't have a lot of money because you're not making anything. And so it was a particularly difficult time to pay the loan back. And that is, the reason why a lot of people got burned and ended up having to pay the penalty on that loan. Because if you don't pay it back within 60 days, not only do you have to pay the taxes on that withdrawal, but you have to pay a 10% penalty on it. They changed that law with the 2018 tax changes. And now, instead of only having 60 days, you have until your next tax day. So if you take out a loan in February, you have until April of the next year to get that money back into the account. In fact, if you file an extension, you could get even more months to get that money back into the 401k. So that makes it not quite as dumb of an idea as it was before, but it's still probably a dumb idea. Now, is it better than borrowing from a bank or better than borrowing from somebody else? Well, it might be. It depends on the terms you're getting from the bank and what the money would have made in the 401k. One way to look at a 401k loan that you're paying back is that it's really kind of a fixed income or a bond in that 401k. And so maybe what you should do when you borrow from the 401k is change the asset allocation of the money that's left so it's more stock heavy. And that way the money you're paying into the 401k in interest is kind of like the bond portion of the portfolio. But the question that Mark is asking is this double taxation myth. And I say myth because it is a myth. People say, well, if I borrow from my 401k, then I got to pay that money back with after-tax money. And then I got to pay taxes again on that money when I pull it out of the 401k. But that's not the way it works. You see, any loan is after tax. So the money you borrow out of the 401k is after tax. So the money you put back into the 401k has to be after tax, right? So the money comes out after tax, it goes back in after tax, and then when you finally withdraw it in retirement, it's coming out, it's pre-tax and you have to pay taxes on it, okay? But it only gets taxed once. It gets taxed when you pull it out of the 401k. I hope that helps. If you are still a little bit confused about that, probably the best example I know of it is a blog post written way back in 2008 by the Finance Buff, in which he talks about 401k loans. And that's certainly worth taking a few minutes to read if you're really worried about this. The post is called The 401k Loan Double Taxation Myth. And he has a nice diagram there and a nice explanation of why that's really not an issue. So if you want to borrow from your 401k, don't let the double taxation myth be what keeps you from doing it. Let the idea that it's just generally kind of a bad idea to be raiding your retirement accounts for your spending needs now is a bad idea. Okay, next question comes from Jesse.
Dr. Dolly, thank you for what you do. I'm a physician and receive the majority of my income as a W-2 employee, but also receive about $35,000 in 1099 income each year. I am already maxing out a Backdoor Roth IRA for myself and my spouse, as well as HSA and my employer 401k. What, if any, are the tax advantage investment options for folks that have 1099 income in addition to W-2 income?
Okay, this is a question I get all the time. Jesse made $35,000 in 1099 income, but as his main job is a W-2, right? He already maxed out his 401k there, so he's already put his entire $19,000 employee contribution into the 401k, plus whatever he could get from the employer. The good news is, if you have a separate source of income, a separate company, in this case, the one that Jesse owns himself, that is bringing you income, you can have another retirement account for that. Okay? There's a few rules about it. First of all, you could use a SEP IRA. I would generally recommend against that. And the reason why in this scenario is because it screws up your Backdoor Roth IRA pro rata calculation. Remember, you got to have a $0 balance in all of your traditional IRAs, simple IRAs, and SEP IRAs in the year that you do a Roth conversion, or that conversion is going to be pro rata. And so you generally don't want to use a SEP IRA if you're doing Backdoor Roth IRAs. So what does that leave you? That leaves you an individual 401k. And in this situation where the $19,000 employee contribution has already been used in the employer's 401k, all you have left are what we call employer contributions, which is 20% of your net income from self-employment. So net income is your profit minus half of the Social Security and Medicare tax that you owe from that income. 20% of that is what can be contributed to a SEP IRA or a solo 401k. It's actually the same contribution amount in this situation. So in this case, he's making $35,000, so he'd be able to put what in there? Maybe $7,000, something like that, into a individual 401k. That's a nice tax break. It's $7,000. It won't be taxed at his marginal tax rate, and it's money that'll be now somewhat asset protected as well. So it's worth doing, I think, for that amount of self-employment income for sure. Our next question comes from Gary.
I'm a longtime listener of the podcast and a multiple year reader of the book and your blogs. I just got off my second phone call with the Personal Capital, and I just wonder if you would comment on their market sector approach with the 10 stocks per sector and rebalancing whatever, and just versus index investing that's often discussed with you guys and many of the Vanguard folks and whatever. So please comment on their approach, if you would, pros and cons. Thanks.
Okay, this one is a complicated question. He's asking about an active management technique used by a financial advisor and wants my opinion on it. Well, in general, I'm not a big fan of active management. I prefer passive investing strategies. And, if you ask Personal Capital whether this is active or passive, they're going to call it passive. But in reality, this is kind of a factor-based, somewhat active strategy. And what they are doing is they are mostly doing what we call equal weighting. And the idea behind equal weighting is rather than taking your stocks and weighting each of them by how much that company is worth, that's what we call capitalization weighting. That's what most index funds do. They decided to put equal amounts into each sector, and then within each sector, equal amounts into each of 10 or 12 stocks in that sector. So basically, they're creating their own mutual fund, their own kind of passively managed index fund, but it's equally weighted rather than capitalization weighted. There's a few downsides to doing this. One of the downsides is that it's not terribly tax efficient. And so you can run into some issues if you're doing this in a taxable account. There's lots more buying and selling going on, and every time you do that, you got to pay capital gains, especially if you end up having to pay short-term capital gains. So that's one issue. The other issue is it's a lot more complicated. You got to pay somebody to do this. Personal Capital charges 0.89% per year. And so if you're doing this just to try to get some outperformance from this technique, it's got to be at least 0.89% per year better than just a standard by the index funds capitalization weighted plan. The idea here behind most equal weighting plans, and the reason why a lot of times the back-tested data shows that they outperformed, is usually attributed to factor investing. That's this idea that over the long term, small stocks and value stocks outperform large stocks and growth stocks. You see, by equally weighting it, more of the money is being put into smaller stocks and more of the money is being put into value stocks rather than large growth companies like Apple or Walmart. And so that is why, this theory is supposed to work. Now, whether it will work and whether it will work better than 0.89% per year after tax going forward, well, that's anybody's guess. This is investing. You makes your bets and you takes your chances and you get what you get. But whether you want to go and do that, I'll leave up to you. Personally, I do not invest that way, but it's not like it's some insane method of investing. As reasonable investment strategies go, it probably falls into the realm of reasonable. It's just a matter of whether you think it's better than the default capitalization weighted index funds and whether you're willing to pay for it. Our next question comes from Daniel, who asks, let's listen to it.
Hey, Jim. Thanks a lot for the podcast and the White Coat Investors site. I feel like it's been an immense help to me and my family already. Regarding my question, it's about how to fund an HSA properly. If I'm in a job for only half of a year that offers a qualifying high deductible health plan, does that mean I can only fund half of the HSA?
He's basically asking how to fund an HSA properly for part year eligibility. So the way this works is if you are eligible for an HSA for 4 months of a year, you have a high deductible health plan for 4 months of the year, you can make 4/12 of the contribution for that year. For 2019, a single person, an individual, can contribute $3,500 to an HSA. So if Daniel was just an individual without any family members, no kids, no spouse, and was eligible for 1/3 of the year, he'd contribute 1/3 of $3,500. That limit is $7,000 for a family, and that can be you and a child, or that can be you and a spouse. However, there is one interesting twist on this, and it's what they call the last month rule. If you have an HSA eligible plan, okay, a high deductible health plan, that's not necessarily one that just has a high deductible, but it's one that the government calls a high deductible health plan. If you have it in place on December 1st, you can make the whole year's contribution. Pretty cool, right? You just have it for a month or two at the end of the year, and you can do an entire year's HSA contribution. The only catch is you have to keep that plan for the next year. You have to be eligible for the entire next year, or basically it goes back to just letting you make 1 month's contribution worth to the HSA. So good question. It's important for those who aren't eligible for a high deductible health plan for the entire year. Next question comes from Jeremy.
Hi, Jim. Thanks for what you do. I'm hoping you can talk about your experience with the white coat investor filing as an S-corp this year. And I'm hoping that you can kind of put your thumb on the point when it makes sense for a small business to file as an S-corporation, and when the added complexity just simply does not add any value. To give you a background, I live in Massachusetts, and on the Massachusetts form, you must have a balance sheet. So on the federal, you have to have a Schedule L and M1, regardless of income. We have a corporate effective tax rate of 9.5% with a minimum tax of $456. I'd love to hear your thoughts. Thank you.
Okay, so Jeremy is asking, when does an S-corp make sense? All right, this is actually a complex question to start with, and it just became more complex in the last year. So let me outline a few general principles, and then the truth of the matter is anybody who really wants the answer to this is going to have to run the numbers themselves, and they might even have to hire a professional to help them do it. The general reason why a typical doctor forms an S-corp is in order to split his income into two categories. The first is salary, and the second is distributions. And the benefit of putting as much as you can into distributions rather than salary is you don't have to pay payroll taxes like Social Security and Medicare on the amount that you call distribution. Now, for a typical doc, you've got to pay yourself a reasonable salary anyway, and that's going to be a high enough number that you've maxed out your Social Security taxes anyway. But it might not be but you'll still could save some money on Medicare tax. Well, how much is Medicare tax? Well, it's 2.9%, with half of that being a tax deduction for the business. So in reality, maybe it's 2.2% once you take into account that deduction. And so what is that worth? Well, if you can call $100,000 distribution instead of salary, you just save $2,200 in Medicare tax. And so there's a certain amount of hassle involved with forming an S-corp, right? He mentioned some of the tax returns, and I'm familiar with them because I've been filling out these tax returns the last couple of years. But there's a bit of hassle there, and you got to send in all this money, and you got to file W-2s, and there's a lot of paperwork hassle. At a certain point, if you're not saving a significant amount of taxes, it's not worth the hassle. And my general rule for that in the past has been $100,000. If you're not calling at least $100,000 distribution for a typical doctor, it's probably not worth forming an S-corp to try to save those Medicare taxes. But if you can call at least $100,000 distribution, then I think it was probably worth doing. Now, bear in mind that the money that you call distribution is not eligible to count toward the amount you need to make to max out your retirement accounts. So if you want to max out a 401k, an individual 401k, and you've already used your employee 401k somewhere, employee 401k contribution in a different plan, you have to make a lot of money in order to max that out. I mean, this year the maximum is $56,000. So basically multiply that by 5, and that's got to be the amount of salary you have to pay yourself. And so unless you're making pretty good money at that 1099 job, it's going to be tough to have enough above and beyond that to justify the hassle of the S-corp. Okay, so as you can tell, it was a complex decision even a couple of years ago, but it just became more complex with the new 199A law. Okay, this is the new tax deduction for self-employed individuals. And so you actually calculate this differently for a sole proprietorship versus an S-corp. And if you have an S-corp, basically it comes down to also a factor that applies that deduction can be no larger than 50% of what you're paying out as salary. And so now there's an additional factor going into this. And really, I can't give any sort of general rule of thumb here anymore. You really have to run the numbers yourself and see which way you're going to come out ahead. You know, is the additional Medicare tax savings going to make up for the loss of the 199A deduction, etc.? You just have to run the numbers, and you're probably going to need some help from your accountant unless you're preparing your own taxes. And if you are preparing your own taxes, good luck. You're going to have to sit down and work your way through this 199A law, which I think all of us are struggling a little bit with this year. I'm planning a blog post on it, but I probably won't write it until I figure out what my deduction is going to be and work through that tax form myself. I think I'll understand it a lot better by then. But really, that factor has to be taken into account now that we have this new deduction available. All right. Well, that was a lot of questions from guys. I need some questions from women here. Let's go over to the email box here for a second. And I've got a question from a woman who says, I was recently accepted into medical school. I'm very excited to get the Texas in-state tuition. I would be too. Texas is a great place to go to medical school. I'm currently in my second gap year working at the NIH in Bethesda. I'm trying to decide if I should open and max out a Roth IRA or keep this money to use during medical school. I'll be taking all loans for tuition and other expenses. I will likely take loans from my parents. Interest-free, of course. That's nice. Appreciate that. Remember, by the way, anytime that parents give loans, that the amount of interest that's forgiven, because you're required when you give a loan to charge at least a minimum amount of interest, the amount that you're forgiving is considered a gift. So beware the gift tax laws when you do that. But she says, I'll still have to pay that back to my parents. Is it worth starting retirement savings early or keeping that money in order to lower my loans? There's no right answer to this question. I love Roth IRAs, right? Getting that money in there, get it compounding. It's tax-free forever. It's asset protected. The estate planning is facilitated with it. You can leave it to your kids and stretch it out even longer. Roth IRAs are a great thing. But so is minimizing your debt. Bear in mind, when you are in med school or going into medical school, the greatest investment you can make is in yourself and your future earnings ability. And so that's not a bad thing either, to reduce your loans. And given what most medical students are borrowing at these days, which is 6 or 7%, that's essentially a 6 or 7% guaranteed investment. And I think I might pass up a Roth IRA if I had a 6 or 7% guaranteed investment. It'd be a difficult decision, but I think I might just do that if that was the other option. And just, stack that money up in cash, use it that first year of med school to reduce how much you borrow, and get used to living frugally as much as you can to minimize those loans. I tell you what, for a lot of medical students, it just feels like monopoly money. It's more money than they've ever made in their life, and they just keep borrowing it, and they become debt numb to it, and all of a sudden, 15 years later, they still owe hundreds of thousands of dollars in student loans. So I think that's a worthy goal, to try to lower your loans. I think that's probably what I would use the money for in this situation, rather than maxing out a Roth IRA. But it's not like that's a bad thing to do. It's not a bad idea, and I'll have to leave it up to you as far as how you're going to decide. All right, well, I was combing through my email box. I actually got 2 more questions in on the Speakpipe. This is great. If you want to leave us Speakpipe questions, we're really enjoying these. Just go to speakpipe.com/whitecodeinvestor, and we'll get your voice on the podcast. But these 2 more that we're going to do in the podcast are both from women. So here's the first one.
I'm a physician in my mid-50s looking toward retirement soon. I came across your site only about a year ago, but better late than never. Thanks for what you do. I fired my financial advisor, and I'm still cleaning up the mess. I had a question about an annuity. I own an annuity from the previous financial advisor. I've held it for over 8 years, and it's worth about $100,000. I've been reading that it might be a wise move to do a 1035 exchange into an annuity with cheaper fees. Can you comment on this? Thanks a lot.
All right. So Juliana is asking what to do with this annuity. It sounds like she was sold some crappy annuity from some crappy financial advisor and has been stuck with it for a long time. But she's got $100,000 in it now, and she wants to know what to do with it. Well, the best thing to do with it at this point, I mean, it's hard to know without knowing what the basis is. I mean, maybe she can just cash it out and won't have to pay much in taxes on it because it never appreciated much. But I suspect she's got a fair amount of appreciation in there. So it's probably worth exchanging it to a low-cost variable annuity like those that are offered by Vanguard. This is called a 1035 exchange, and basically all the cash value from one goes into the cash value of the other, but you basically instantly have better investments in there and you have lower fees. So it's a no-brainer to do that. The only other alternative would be, is it worth just cashing out and investing in a taxable account or using the money to pay off debt or using the money to max out retirement accounts, etc. But certainly getting out of some old crummy high expense annuity with crappy investments is usually worth doing. All right, a final question is from Nicole.
Hi, Jim. My husband and I are finally maxing out all of our tax advantaged accounts this year and going to be opening brokerage accounts. I'm wondering if we can open a joint taxable brokerage account under both of our names or if we need individual ones. Thanks for everything that you do.
So this one's pretty easy. This is a simple question. Can we open a joint brokerage account? And the answer is yes. You can open an individual one, you can open a joint one, you can do whatever you like. The downsides to a joint one is that your spouse can clean you out. You know, I mean, it's joint and you both own the whole thing. And so you got to watch out for that, I suppose. Another downside, I suppose, is in the event of liability. If for some reason that one person is sued and the other one is not, that joint account becomes something that the creditors can grab. So I suppose it could be a bit of an asset protection technique to put, to have two separate brokerage accounts. In some states, you're allowed to title your brokerage accounts as tenants by the entirety, in which case two spouses would not have to, split that up to get that same level of asset protection. In fact, it's even more asset protection because no matter which spouse was sued, the money would not be reachable. So that's a great way to title a joint brokerage account in I think it's 7 or 8 states that allow that. But yeah, you certainly can open a joint brokerage account. That's how Katie and I have our brokerage account. It's joint. And so the nice thing about that is if one of us died, well, the other one would just keep on going. Nothing would have changed, really. Plus, we both have access to it. It just seemed the right way to do it to us. We have both of our names on the house. We have both of our names on most of our vehicles, although I think technically she owns the boat. I guess the day we bought that, I felt like that was going to give me some additional asset protection or something. But we have both of our names on our brokerage accounts and our bank accounts as well, and I think that's what most people do. All right, be sure to check out our recommendations page. We have a recommendation for just about every financial professional you want to get in touch with. This episode was sponsored by First Republic Bank. You worked hard to get your degree, and you continue to work hard to pay off your student loan debt. Consider a refinance with First Republic Bank and start working on what matters most to you. First Republic can offer you fixed rates on your student loans that are among the lowest in the country and could potentially save you thousands. First Republic is committed to helping you get out of student loan debts faster so you can enjoy the benefits of your hard work sooner. Visit firstrepublic.com/whitecoatinvestor to learn more about First Republic's low rates and extraordinary service. That's firstrepublic.com/whitecoatinvestor. First Republic Bank, member FDIC, and equal housing lender. Head up, shoulders back. You've got this and we can help. We'll see you next time on the White Coat Investor Podcast.